Hello everyone. Welcome to the Wolf Investing Theory. This approach focuses on building generational wealth by combining instinct and intelligence. Like a wolf, successful investing requires patience, to wait for the right opportunities, precision, to make well-calculated decisions, and protectiveness, to guard your assets wisely. By embracing these qualities, you can create a lasting financial legacy for future generations. I'm Shivaputra MC, an AMFI-registered mutual fund distributor, here to guide you on this journey. Wolves thrive because of their deep instincts and strategic behavior, which is exactly what defines the world's greatest investors. Let's break down these traits. First, patience in action. Great investors wait for the right price instead of jumping on every opportunity. It's about being selective and disciplined. Next is calculated aggression. When opportunity meets preparation, they strike boldly and decisively. Social intelligence is another critical trait. Successful investors rely on advisors, networks, and communities to make informed decisions. Resilience is essential too. Market downturns test your resolve, and staying power is what separates the winners. Lastly, there's the territorial instinct. Knowing your assets deeply and never investing blindly ensures you protect and grow your territory wisely. These characteristics combined make the difference between surviving and thriving in the investing world. Let's dive into the first 4 of the 7 wolf-style investment strategies. First, focus on stalking high-quality assets. This means targeting companies that have durable competitive advantages, often called moats, along with prime real estate and top-tier ETFs or index funds. These are the kinds of investments that can provide long-term stability and growth. Next, wait for the kill, or in other words, be patient and wait for the right price. Even the best companies aren't good investments if you pay too much for them. The goal is to buy wonderful businesses when they're priced fairly or at a discount. The third strategy is to build reserves, essentially creating an emergency cash buffer. Having cash on hand lets you weather market downturns without panic and also positions you to seize opportunities when others are selling in distress. Finally, diversify your hunting grounds by spreading your investments across different asset classes like stocks, bonds, real estate, and commodities. Just like a wolf pack hunts various prey, diversifying helps manage risk and capture different growth possibilities. Let's continue with strategies 5 through 7. First, number 5 is study the terrain. This means you should never invest blindly. It's crucial to thoroughly examine the business model, understand market trends, and analyze the broader economic conditions. Using fundamental analysis alongside macroeconomic indicators will help you make informed decisions and avoid unnecessary risks. Moving to strategy 6, guard your wealth. Protecting your investments is just as important as growing them. Implement measures like stop-loss orders and hedging to limit potential losses. Additionally, ensure you have adequate insurance coverage and think long-term by setting up a will and trust. This way, you can facilitate smooth wealth transfer across generations and safeguard what you've built. Finally, strategy 7 is hunt in a pack. Investing doesn't have to be a solitary activity. Join investment clubs, attend seminars, and participate in online forums. Engaging with others allows you to learn from their experiences and mistakes, which can sharpen your own instincts and make you a smarter investor overall. Collaboration and shared knowledge are powerful tools in navigating the investment landscape. Let's talk about how wolf psychology can actually teach us some valuable lessons when it comes to investing. First, there's territoriality, which I like to think of as your core portfolio, your den. This should be a collection of stable, reliable assets that you don't touch often. Think of it as your safe haven, something calm and consistent that forms the foundation of your investments. Next is hierarchy and roles. Just like wolves have their roles within a pack, you need to understand your own investor profile. Are you an alpha, someone who is aggressive and willing to take risks? Or are you more of an omega, preferring a conservative approach? Knowing your risk tolerance, your goals, and your timeline is essential before making any investment decision. Then, we have tracking and monitoring. Wolves track their prey carefully, and you should treat your portfolio the same way. Regular reviews, whether monthly or quarterly, will help you stay on track and make sure your investments align with your evolving goals. Finally, survival instinct is key. Wolves are experts at conserving energy and avoiding unnecessary risks. In investing, this means never overextending yourself. Avoid excessive leverage or risky moves just because the market looks tempting. Your primary goal should always be long-term survival and stability. Here we have an important mindset shift to consider, moving from a prey mentality to a predator mentality when it comes to investing. Most people invest like prey. They react emotionally every time the market moves. They buy when prices are high, panic sell when things drop, chase after the latest hot tips, and essentially hope for the best without a clear plan. This reactive approach often ends up transferring wealth from them to those who are more patient. On the other hand, predators like wolves act intentionally. They have a plan and stick to it. They wait patiently for the right opportunities and don't let emotions dictate their decisions during market turbulence. Instead of reacting to every headline, they trust their strategy and focus on building lasting, generational wealth. As Warren Buffett famously said, the stock market shifts money from the impatient to the patient. So, adopting the predator mindset is key to long-term investing success. Let's look at some legendary investors and the lessons we can learn from their experiences, starting with Warren Buffett. After the 1987 market crash, Buffett demonstrated incredible patience and deep understanding of his territory by waiting for Coca-Cola, a company he knew well, to reach a fair price before investing. This disciplined patience paid off enormously, with his investment growing more than 20-fold and continuing to yield significant dividends decades later. The key takeaway here is to truly know your market and wait for the right opportunity, even if it takes years. Next, we have Ray Dalio, known for his adaptability and pack thinking. Dalio created the all-weather portfolio, which balances risk across stocks, bonds, and commodities, enabling it to perform steadily in any market condition. This approach is similar to a pack hunting multiple prey, adjusting strategies based on the environment. His approach has become a benchmark for balanced investing, delivering consistent returns through various market cycles. The lesson here is to diversify and be adaptable, leveraging your team, advisors, and tools to guide you through changing conditions. Finally, John Templeton embodied calculated aggression. At the start of World War II, while many were fleeing the market, he boldly borrowed $10,000 to buy shares in every NYSE stock trading under $1, some even in bankruptcy. This daring move multiplied his portfolio several times over by 1943, leading to the founding of the Templeton Growth Fund. Templeton's story teaches us to act decisively and with conviction when opportunities present themselves, especially when fear has driven others away. Fear, after all, can be the greatest opportunity if met with preparation. Here's a quick overview of the key traits of a wolf investor and how they translate into successful investing behavior. First, patience is crucial. Instead of chasing every opportunity, you wait for the right price and let value come to you. Then, aggression comes into play when you have high conviction. This means buying boldly, especially during market bottoms when opportunities are often greatest. Pack thinking highlights the importance of leveraging advisors and being part of investment communities, so you're not making decisions in isolation. Territoriality reminds us to know our assets deeply and avoid investing in anything we don't fully understand. Resilience is about staying invested through downturns and resisting the urge to panic sell. Reserve building ensures you maintain an emergency fund, typically 3 to 6 months worth of cash, to keep you stable during uncertain times. Lastly, tracking your portfolio regularly through monthly or quarterly reviews helps keep your investments aligned with your goals. Together, these traits create a disciplined and informed investor who can navigate the markets wisely. When it comes to building wealth, it's not just about the numbers or the technical details. It's also deeply psychological and strategic. Think of it like a wolf's approach to survival and success. First, you need to hunt. This means stalking and identifying the best opportunities. Take the time to screen for high-quality assets by researching their competitive advantages, financial health, and market trends. Build a watch list, but don't feel pressured to jump in too quickly. Next, you strike. Buy with conviction, but be patient. Wait for a fair or discounted price where quality meets value. When the moment is right, act decisively and size your investments based on how strongly you believe in them. Then you guard. Protect your wealth and diversify across different asset classes to reduce risk. Make it a habit to review your portfolio regularly and use tools like insurance and estate planning to secure your financial position. Finally, you thrive by passing on what you've built. Create a will and trust. Educate the next generation about wise money principles and focus on building wealth that lasts well beyond your lifetime. This is your Wolf Wealth Blueprint, a holistic approach to owning your financial future. When it comes to building lasting wealth, think like a wolf. Be patient, waiting for the right moment to make your move. Be precise, making decisions based on careful analysis and strategy. Be protective, guarding your assets and legacy fiercely against any threats. Hunt smart by researching and planning every step. Strike bold when the opportunity is clear and confident, and guard fiercely to ensure your wealth stands the test of time. This approach is how you build a legacy that spans generations. If you have any questions or want to discuss strategies, feel free to reach out to me via email or phone. I'm here to help you navigate your financial journey with confidence.